Hello and welcome to the very first episode of Southbank Live. This is a trial that we're just figuring out. It's going to be a live show where we discuss market movements and interesting events we've seen in the news, while at the same time in a live format, so you get that commentary and you get that some more engagement with our audience, something more rapid fire than we normally get, sending out our newsletters and then receiving emails afterwards. My name is Boaz Shoshan. I'm an editor at Southbank Investment Research, and I'm joined today by John Butler, a gold expert, and who also works here at Southbank Investment Research and many other places from time to time. John, thank you so much for joining me.
Thank you, Buzz.
Yeah, John, now just to start off with today, there is a very interesting, the rather esoteric subject, which I thought would be very good to explore just in this first episode. So just something that's going on somewhat behind the scenes, but may have some really quite broad market implications. And this is the sort of the niche topic of Basel III. What is Basel III, and what is it that our readers and our viewers today should know about it?
Well, it is indeed an esoteric topic, and yet it's one that really is essential and at the heart of the modern financial system, which is international. It's cross-border. And so the Bank for International Settlements, based in Basel, Switzerland, has put together a set of banking regulations which are meant to largely harmonize the way bank capital calculations are made throughout the modern financial system. Now, national bank regulators remain responsible for their respective banking systems. However, the idea is that they will all agree to implement and enforce the Basel III agreed framework going forward, such that they can have a certain degree of confidence that certain banks in certain jurisdictions won't be playing fast and loose with their definition of bank capital, such that they might threaten the banking system more generally, cross-border internationally, in the event that they run into difficulties with their liquidity and with their solvency.
Right. Now, there are lots of little threads that we could pull on with this. There's a very interesting gold element, within there. But as you say, it is very broad when it comes to banks and how they conduct their business. And and also I should have mentioned this earlier actually to our viewers. Do feel free to leave any comments or indeed to ask any questions in the chat. We will get to those as long as we have time, that is. But just, John, could you explain what, when it comes to Basel and the Basel Accords as they are known, I mean, just how broad and how fully encompassing are these accords? So, for example, you've got say Standard Chartered here in the UK, which does most of its business over in Asia. Or if you took, one of the Chinese banks, one of the big Chinese banks, I mean, are they also beholden or in agreement on these rules? Is there any part of the globe which is sort of left out by the Basel Accords?
Well, you mentioned China, and the Chinese financial system is not sewed together with most of the rest of the world. I mean,
Right.
they have their ad hoc bilateral arrangements when and where it's convenient. But no, that China will not be following Basel III to the letter. That said, to the extent that they want to be able to participate in cross-border finance with their counterparties in trade, investment, you name it, they'll kind of have to nevertheless be able to demonstrate a certain amount of conformity, just because this is the way banks conduct themselves anyway. And keep in mind, I mean, every bank is going to have its own internal risk systems. Some banks are going to be more conservative than others. The point of Basel III is really to try and take what you might regard as general best practice and try to harmonize it so regulators at least can at least have cross-border conversations where they're using the same vocabulary, referencing similar classes of assets, similar types of risks. I mean, it's no guarantee, of course, that you'll get 100% conformity, even in the jurisdictions that fully participate, such as the UK, such as the Euro area, such as North America, and so on. But it does provide for that sort of framework.
Yeah, I guess the idea is that everybody is singing off the same hymn sheet. What one person's description of risk is not going to be different from another bank's description of risk. When it comes to, I mean, Basel III, Basel one and two, interestingly, Basel II was actually blamed in by many people for the financial crisis itself in 2008, and it was adopted and implemented not too far before the financial crisis. So some people think that the upcoming implementation of Basel III maybe will lead to something similar. What is Basel III really going to do when it comes to changing the financial system as we know it?
Right. Well, Basel III is particularly concerned with the way in which derivatives are held on bank balance sheets and the amount of capital that banks need to hold against their derivative positions, including, importantly, credit derivatives, which are widely assumed to have been the source of the financial crisis that got going in 2007 and really blew up in 2008. And so Basel III has spent most of its time trying to come up with a framework for credit derivatives as well as other forms of derivatives. And, and that is obviously very different from the way the Basel guidelines originated. I mean, they really originated at a time when banks were in a more rudimentary business of taking deposits and making loans
Right.
and not really having big derivatives trading books. But of course, all of your so-called strategically important financial institutions, the ones with systemic risk on their balance sheet effectively, the ones that are too big to fail, that's where the big derivatives trading takes place. That's where at least the notional amounts, if not the net risk exposures, are by far the largest. And so this is where the vast majority of effort to upgrade, as it were, from Basel II to Basel III has gone. And banks are themselves, of course, the source of these derivative risk metrics, guidelines, management frameworks, and that will have flowed into the harmonization that takes place under Basel III.
Right. Going in even more into a niche of this somewhat niche subject, when it comes to gold and it comes to gold derivatives, that's where this becomes something that has been of interest for a long time for gold investors. I've seen gold investors and gold commentators speak about Basel III for years now. And now that we're getting closer to its implementation, we're hearing this a bit more. Could you tell us how exactly is Basel III going to affect gold?
Well, it's an interesting one, right? Because I mean, as we've just discussed, we're talking about Basel III being largely an effort to try and harmonize the risk treatment of exotic, sort of derivatives,
Yeah, yeah.
which is the farthest possible, other side of financial activities than physical gold you can practically imagine. And yet, because Basel III is meant to be universal, it nevertheless does capture gold as an element of the risk that banks take and will have to manage under Basel III going forward. And this is where it gets interesting because, of course, physical gold is physical gold, right? It's a rock. It's not going to default. It doesn't really represent any risk at all,
Yeah.
except in the liability price risk terms of the financial institution trading in that physical gold. So, for example, if your liabilities are denominated in pound sterling, and you take a hit on your physical gold position in pound sterling terms, that's still a loss, and that has to be provisioned against in pound sterling terms. And this is true of the base currency of any financial institution. Gold is not a base currency, and yet it kind of functions as such within the gold market itself. And this is where the London Bullion Market Association is concerned about the way in which the Basel III regulations will be imposed on the London bullion market or the global gold market more generally. And it comes down to this. Under LBMA convention, while there is, of course, underlying physical metal being traded between financial institutions, when it comes to day trading, when it comes to active risk management, much of that is done in so-called unallocated gold. That is, rather than referring to a specific bar in a specific vault, banks are simply settling the transactions simply in ounce terms in an unallocated fashion without the actual physical needing to trade hands in real time. Now, this is the LBMA they claim that such unallocated gold trading for settlement purposes and day trading purposes, they claim that it's really not a gold derivative per se. It's effectively physical gold. It just hasn't been fully settled yet. But that isn't necessarily the case. And one reason why you can argue it's not the case is because the volumes of unallocated trading that take place within the LBMA institutions is an order of magnitude larger than the amount of physical gold that exists. And again, if you're day trading it back and forth, you could say that's not a problem. You'll settle it at the end of the day. But in fact, these unallocated positions are rolled over indefinitely. They really are. They never settle. And so it makes you wonder whether, to some extent, that float is not fully backed by physical gold. And if it's not, it really is just a derivative. It is a claim on gold, not gold itself. The two are not the same. And when you argue, therefore, that there's also leverage in the system, banks are highly leveraged institutions, then you're in a situation where I think Basel III correctly treats unallocated gold as a derivative of gold rather than gold, physical gold itself.
Right. So unallocated gold. This is, this is a subject that gets a lot of attracts a lot of debate within the gold investing community as to whether or not it's real gold, whether or not one should treat unallocated gold the same way as you would treat physical bullion that either you have with a custodian or even within your own possession, right? But your argument, if I understand it correctly, is that there is simply so much unallocated gold that gets traded, far more than is in the LBMA's vaults, that it's very hard to see how all of it is somehow backed. So if everybody wanted to make their unallocated gold allocated, they wanted to make sure they knew where the bar of gold that this unallocated paper slip, is held, there would be not enough gold to go around. And you see, I remember reading from the World Gold Council, so the lobbying group for the gold mining industry, saying that if everybody did want to suddenly get their unallocated gold allocated, things would be very exciting for a short period of time because there would be a big scramble for it. Because if I'm correct, do correct me if I'm wrong, John, but it is some unallocated gold. It's actually yet to be properly refined yet. Is that correct?
No, that would not be allowed under LBMA terms. That
Right.
said, what is allowed, of course, is that there's lots of financing which is secured by gold in some way.
Right.
Okay. But what we're talking about here is different. It's unallocated gold that nevertheless is a claim on physical,
Right.
actual physical that must already actually be in London good delivery bar
Right.
format.
Right, right. Okay. Well, sort of taking that in mind then. So we've got the LBMA, which wants to argue that unallocated gold is not a derivative of real gold. And Basel III is a banking regulation, which is effectively, it is an accord, so it's an agreement by bankers. And bank regulators are most of the time bankers. Do you not think the LBMA is going to have its way with the Basel III Accord to some degree and get away with the unallocated gold, or is this something they won't be able to avoid?
Well, certainly they're trying, right? They're trying to get an exception. And keep in mind, the LBMA is a venerable institution. It does carry with it a certain amount of gravitas.
Yep.
And I certainly think it is possible that they will manage to get an exception here. Certainly, the UK regulatory regime, I would assume, is fighting their corner on this one with
Yep.
respect to their other regulatory counterparts at Basel. So, that they might well, but it's interesting what it's brought out because in the LBMA's official complaint, when they define what unallocated gold is, they make explicit that the holders of unallocated gold accounts are unsecured creditors of the banks. That is, they are taking bank counterparty risk. Clearly, that is not physical allocated gold. Clearly, it's a derivative. So, in a way, they've inadvertently kind of showed their hand. And I wonder, but they had to. I don't think they had any choice. So the question isn't whether they admit that unallocated gold is effectively a derivative. The question is in the politics and the regulatory politics at Basel, and whether they will get their way or not.
Yeah, if I were to play devil's advocate, I do agree with you, John. But if I were to play devil's advocate there, could one not argue that a fully allocated gold bar, so a gold bar that is definitely held in in custodianship somewhere in a bank vault, could you not still argue that it's well, I guess it would just be you are a secured creditor rather than an unsecured creditor. But even a secured creditor, there is a degree of credit risk there. And there is still a degree of, ultimately, even if it is secured there, it could go missing. There could be fraud taking place. Would you agree with that, or am I
Look,
good?
okay, fine. I mean, the world's an imperfect place. I mean, there could be some bizarre disaster. Who knows what could happen? But it would be a proper force majeure
Yeah,
event rather than a credit event in legally defined terms. So
right.
I think characterizing that as credit risk is not. It's a bit misleading. But risk in a force majeure sense, fine. I mean, there's risk in anything. But it's nevertheless important to distinguish between physical and unallocated
Yes. Yeah.
gold, as indeed the LBMA very much does. And this has really been brought out in the open by Basel III, which again is interesting for those of us who have long observed the evolution of the gold trading market in recent years.
Right. So, say for example, LBMA doesn't get its way, doesn't get that exception, and unallocated gold is treated as a paper derivative of gold and not the same as allocated gold, or just simply physical gold for a bank. What then happens to all of these massive trading volumes that you've described that are massively in excess of the actual gold holdings of all these banks? And what does that do to the gold price? Because much of the gold price, as we know it today, the spot price, is set by those massive paper gold trading volumes.
Right. Okay. So what happens in that case if they don't get their way? Then banks are going to have to set aside capital against their unallocated gold liabilities. That is, in the event that the gold price goes against them, and that means that the cost of making a market in unallocated gold is going to go up, and because unallocated gold provides the bulk of the liquidity within the LBMA system, then other factors equal, it's going to be more expensive to trade gold, right? The banks will have to push those costs onto their customers. And the market will have to evolve to try and keep those costs to a minimum and nevertheless provide for reasonable liquidity in the market. Look, markets evolve, right? Markets adapt. This is not going to be the end of the gold market, but it would perhaps make for a rough transition period when temporarily the cost of trading gold is somewhat higher. And other factors equal, some counterparties might choose simply to withdraw from that market, at least for some period of time, because they'll struggle to make it profitable. And you'll end up with fewer players, which could also damage liquidity. But again, markets evolve. If you end up with too few players, then some upstart with perhaps some new trading technology that's super efficient, better price discovery, whatever it is, will jump in to fill that gap. So I don't think we should be sort of long-term pessimistic that this won't still allow for a functioning global gold market. I think it
Yeah.
absolutely will, but it's not quite clear what trading conventions, which counterparties, so on and so forth, will prevail longer term. Now, one thing, however, to point out here is the following. Keep in mind that one reason why banks probably like making a market in unallocated gold is because they don't have to provision capital against it.
Right.
I mean, I'm not. I mean, this is going to sound a bit glib, but you could argue that you can just write unallocated gold contracts all day long as a way to practically print money for nothing. That's an exaggeration, but the temptation when you don't have to set aside capital for a given trading activity, the temptation is there to overdeal in that trading activity. That temptation will be removed if the LBMA does not get this exception.
Yeah, there was I once spoke to a chap who he posed an interesting question about it when it came to banks and being able to hold gold as a zero risk sort of instrument. And he said he couldn't quite understand why somebody, with devious intent had not set up a bank, got a banking license, and just levered the bank up to the hilt, buying physical gold, and then just stolen all the gold. Because effectively, as a bank, you can, if it's a zero risk instrument, then you can lever yourself up hugely with this stuff, and then just make up with a massive load of gold bars somewhere. And I know I wasn't really able to answer him properly. I mean, I imagine it's a lot trickier than that, but it is an interesting idea.
It's important to distinguish under Basel III that the credit risk or the risk of derivatives and their counterparties is treated separately from the pure price risk of the underlying instrument.
Right.
And so if your liabilities are denominated in pounds sterling and you have a position in physical gold, you still need to provision against the price
Price
risk of
losses.
gold going down in sterling. That still requires capital. However, there's no credit risk component that needs to be provisioned against.
Right.
And that's one reason why, for example, you can't fund yourself in sterling or dollars or any other currency and just corner the global physical gold market in a risk-free way, because look, it's possible the price goes against you. I mean, gold doesn't always go up, at least not in the short term, right? And so that game would be a very dangerous one to play.
Yeah. When we're talking about this, John, the whole Basel idea. I mean, could you give us something of a history of Basel? We're on Basel III now. Who is it? Why did this happen in the first place? Who are the guys that are actually making this decision? I would imagine, some of the Swiss banks, which maybe have a lot of gold interests, at least, would be involved with some of that. What is it? Why did we start with Basel I?
Right. Well, it has to do with the evolution of the international financial system. And during the post-war period, there was a gradual move led largely by the United States and the United Kingdom to try and best liberalize cross-border capital flows and make sure that capital controls were generally not imposed at all. And indeed, this even eventually extends to most emerging markets, although there are still pockets of capital controls in a number of emerging markets today. But the erosion's been quite substantial. But okay, so in theory, why don't we want free movement of capital around the world? Why shouldn't investors be able to seek out the best investment somewhere, regardless of where it is? Why shouldn't banks be able to finance a multinational company, regardless of where it's doing business, so on and so forth? I mean, if you kind of believe in free market capitalism, you don't believe in capital controls, and you want to encourage that free movement of capital. As that movement of capital became ever more international in the 60s, 70s, and 80s, it was decided that there had to be at least some harmonization of cross-border regulatory frameworks. And they used the Bank for International Settlements as the institution within which those discussions would take place. And so they have evolved through these iterations, 1, 2, and now 3, to encompass a growing portion of the activities of banks, such that the amount of harmonization extends not just to typical business loans or typical household loans or whatever it is, but to exotic derivatives, right? The broadest possible net is being thrown over banks' activities with Basel III to try and capture some of those shadow banking activities that remained in the dark going into 2007, 2008.
Right. On that note, when it comes to bank regulation as a whole and whether or not it's possible to regulate the global financial system like that, I mean, do things like offshore banking not get in the way of this when it's not really under the purview of any national regulator?
Well, no. Offshore banking centers are regulated, okay? And in fact, some of them are regulated in an extremely strict and robust way, in part because those offshore centers depend on their access to the international capital markets
Right.
to exist, to provide the money services, to provide the tax neutral accounting jurisdictions that are needed for any modern multinational company to run its books in a tax efficient way. And I mean, leave tax evasion aside, right? I mean, there's calculating your corporate rate of income tax as a multinational, requires legions of accountants, legions of tax lawyers, and that's not necessarily to try and evade taxes. That's just to try and comply, right? And these offshore centers simplify that compliance by providing a tax neutral jurisdiction where you can kind of net your books out to some extent. In any event, it really depends on which offshore center you're
Yeah.
talking about. There are some that historically have played fast and loose because because that's their orientation. But actually, I would say a bulk of so-called offshore centers are in fact desperate to be seen as compliant with the Basel regulations.
Right. So we're thinking of places like Bermuda, for example, or and then the Bahamas. So am I right in thinking the Bahamas has historically played a bit fast and loose with the rules?
Yes, they have, but of course they can only get away with so much. Bermuda is an interesting jurisdiction, of course, because that's the seat of a substantial portion of the global reinsurance industry, and it's kind of a historical anomaly that a legacy, I should say, that that's the case. But once upon a time, of course, if you were moving cargoes back and forth between North America or the Caribbean and Europe, Bermuda was a standard sort of stopping off point, and so a lot of insurance brokerage was done, right then and there, as the cargoes moved from whichever jurisdiction in the Caribbean or elsewhere in North America, and then in some cases also cargoes were shifted, from one hold to another, and so in any event, Bermuda has a long history of being deeply integrated with the British and international financial system. And so Bermuda has, again, don't get me wrong, there might be pockets of people playing fast and loose wherever you go, but historically, Bermuda has been a highly compliant jurisdiction for that reason.
Right. Changing gears a bit, John, and I do encourage anybody watching this, if you do have any specific topics you would like us to discuss during this sort of pilot episode, as it were, do feel free to leave it in the chat. Colin, you're very welcome. It's great to have you here this morning. John, could I sort of change gears slightly? We've been talking a bit about gold, and we've been talking a lot about financial derivatives. I think it's a good sort of segue through from gold to the inflation story as we see it these days. The pull off when it came to lumber, the cost of lumber had a grand boom. Now it's going down. All the people who say that inflation is transitory are pointing to this as, oh well, look, it was just a big supply squeeze. Inflation's not going to come back up again. This is just as a result of the Wu flu causing all of these weird bottlenecks when it came to commodities, and sooner or later, it's all going to go back to normal. What's your take on that? What's your take on the inflation story as we see it today?
I think that's part of it, right? Part of it is definitely down to the base effects that were created by locking down economies off and on over the past year and a half or so. That's definitely part of it. But if you take a very, very broad look at global commodities prices, ranging from industrial, non-industrial foodstuffs, energy, you name it, what you do find is the most extreme breadth of general commodity price increases we've seen in an awfully long time. You have to go back to at least 2011 and probably even prior to 2008 to see similar breadth of general price increases. And when I say price increases, I don't just mean from the declines that we might have seen temporarily due to COVID. You can look at your pre-COVID data set, and the breadth of price increases vis-a-vis pre-COVID prices is very, very substantial today. And as I just mentioned, this includes basic foodstuffs as well as industrial commodities. And that's where I think we're going to see more persistence in this wave of inflation than some people believe. And that's because, keep in mind, the vast majority of global basic goods manufacturing now takes place in emerging markets. This is, China, of course, but also others have built their capacity over the past couple of decades, big time, and have taken a huge portion of that market share. But their workers, many of whom are still living at a level which in the developed world's eyes is borderline subsistence level, a huge portion of their household budget still goes to basic food, clothing, and shelter. And so when these households are faced with rising food, clothing, and shelter costs, I mean, they literally will struggle to get by, even from a small increase, and they'll demand higher wages. They won't need to be part of a union. They won't need necessarily to be looking to, for more money to get their nails done. They're simply going to want more food, clothing, and shelter for their family, and they will press automatically for higher wages when they see those prices going up. That's just the way it works.
Yep.
Now, to some extent, producers will be able to absorb those wage pressures in margins, but to some extent they won't. And it's hard to know in advance precisely which businesses and which industries will pass along those rising wage demands to the final consumers of those goods. But some of it will get passed along. That's where we're going to get the persistence in the inflation from. This is a new transmission mechanism, right? We used to largely produce our own manufactured goods. So if you didn't see wages rising domestically, you wouldn't see consumer price inflation rising domestically. That's not true anymore. If you see wages rising in the developing world, you're going to see rising consumer prices throughout the world.
Right. So is it soft commodities then that you're looking at, so being the sort of the key catalyst then for that broader inflation over time? When you're looking at agricultural commodities, wheat, soy, and that, and
I'm,
those.
I'm looking I'm looking across the whole spectrum, but what I'm saying is that the whole spectrum is important, and
Yes,
it's important in a way that I don't think is fully appreciated by everyone.
but they'll find out soon, right?
Well, in a way, they already are. Even those who were pointing to the possibly large base effects that we were going to see coming out of lockdown, even they underestimated the rise in inflation rates we've seen over the past few months. So even we knew what the base effects were going to be already, and yet they nevertheless still under forecasted and undershot it.
Right.
And so, you'd expect at least a little bit of head scratching to be going on. And in fact, I'm sure some is. And I think that some of that head scratching will result in a bit more of the mainstream consensus beginning to consider that perhaps there is going to be more persistence to what's happening here than just the base effect.
When that happens, John, how far ahead of the curve do you think the credit market is going to be? So when you're looking at bonds and people with a very large exposure to them, if you're holding the classic 60-40 portfolio, you're going to be owning an awful lot of bonds. How quickly do you think that's going to occur? How quickly might we see rising yields?
It's really difficult to know because central banks not only control short-term interest rates nowadays, they control essentially the entire yield curve as a result of very substantial quantitative easing programs, which include purchases of longer dated bonds. And so we live in a strange world where bond yields are only going to rise materially if central banks allow them to rise materially as a matter of policy. And they may decide they don't want them to rise materially as a matter of policy, which of course would be a form of financial repression, as it were, which will result in bondholders not being able to keep up with inflation. And I mean, sadly, this type of policy has been followed in the past. There is an element to it which has to do with the need that governments feel from time to time to effectively appropriate some portion of the wealth of the private sector in order to fund the public sector. We associate this perhaps more with third world countries than we do with the developed world, and yet nobody can deny that there haven't been times in the past when the United Kingdom, the United States, or other developed economies have also turned to similar policies. And that's kind of where we are today.
What would you say then to the person who says that stocks are a great hedge against inflation? I would generally argue it really depends on the stock. When you're looking at tech darlings, I wouldn't have thought that they would be a great hedge against inflation. But some people think, well, the inflation story doesn't matter for the person who's just passively buying, an S&P or a FTSE 100 tracker. Like, what's your take on that?
It really depends. Keep in mind what I said a moment ago about some businesses and some industries will take a hit on margins, will absorb some of the wage pressure associated with emerging market wage demands coming on the heels of higher food, clothing, and shelter prices. To the extent margins get squeezed, equity investors will see that. They'll see margins getting squeezed, and they will reduce their profit growth expectations accordingly. and that will hit stock prices. So those industries that are subject to margin squeezes, those industries are going to underperform as inflation pressures build. But there are some industries where margins are already low, but also fairly solid. If you look at basic industrials, for example, this tends to be a low margin business, but the cost of getting rocks out of the ground or other making other basic materials, right, is easily passed on to final consumers. And so if you look back at the stagflationary late 70s, early 80s, basic industrials took a hit, but they actually outperformed most other sectors of the economy, of the stock market. And intriguingly, although it was a far smaller sector at the time, tech did poorly, right? What does tech do? Tech enables investment in future efficiencies. But if you're a corporation struggling to maintain a certain level of profitability in the here and now, you're not going to consider a big new investment in tech at that time. You're first going to just shore up your operations, run what you've got as it stands now, as efficiently as possible, try to get through the rough times, and then hopefully find yourself awash in cash again, maybe in a few years' time. Then you can spend more on tech again and seek new efficiencies out of the future. But we're going to go through, it appears, in my opinion, we're going to go through a period like this where you want to look for pricing power, basic industrials, infrastructure, non-discretionary spending. These are the areas you want to overweight in the stock market, not discretionary, not tech, not the promise of future technology bells and whistles. Those are likely to underperform in this sort of environment.
Right. And I should, of course, stress to our viewers, we are not giving financial advice. Anything that you do here in Southbank Live is mostly a discussion on investment themes. But on that topic, though, John, I mean, one thing that I always find funny with where you're in the state of grand indebtedness that the world is, and you think inflation might be coming around, which is going to burn away some of this debt. Indebted companies are not, or even indebted countries for that matter, are not ones that immediately strike you as, well, this is going to be a great opportunity. But if we are going to a financially repressed world where interest rates are held down while inflation rages, do you think, what's your take on heavily indebted companies as an interesting investment play? Because inflation works in their favor. And they end up almost getting a clean slate if you get sustained inflation over a long period of time.
Look, I mean, the poster child of the sort of company you want to own in this environment is not only one with margins that it can pass on to consumers in the event that your input prices rise, but one that's also highly leveraged up on those margins. As
Right.
long as you can depend on your margin remaining in place, then there's nothing wrong with leveraging up into an inflationary environment. So yes, when looking at a balance sheet, as long as you're convinced that that margin will hold up under input price pressure, you should not be concerned about leverage. You should embrace it.
Right. We do have a question here from Peter. He asked specifically about Bullion Vault and the Bullion Vault, company, which is, does what it says on the tin, as it were. And that's over in Zurich, he asked whether or not the gold that they store for their clients and their customers in Zurich is fully allocated. Correct me if I'm wrong, John. The definition of allocated and unallocated gold is generally something you find within the bullion banking industry, whereas for the investment industry and investment grade gold, is that not sort of a separate definition?
It is, yes. And so your precious metal custodians who provide custodial services to retail investors, to my knowledge, they don't deal in unallocated gold at all.
Right.
Um, I believe that I'm not going to comment on any specific company, but as an industry, my understanding is that your precious metal custodians only deal in allocated gold, which might be in bar form, might be in coin form, um, but they will not deal in unallocated. That said, do your due diligence on any prospective custodian, but that really is the business they're in my understanding, is the allocated business.
Yes, that's definitely my impression as well. Just looking forward, then, John. We have been chatting for a little while here, and of course, anyone viewing, if you do have any topics you'd like us to comment on, do just post them in the chat. It is an interesting format we're doing here. We are still trying it out. It's something of an experiment. We haven't done a YouTube live show quite like this before, where it's public like this. But it is very interesting, John. In terms of the news that you've been seeing over the past week, some of the press, some of the commentary that you've seen coming out, are there any interesting themes that you'd like to bring up here?
Well, what I'd like to bring up is what I feel people aren't necessarily looking at. What's staring us in the face, and what everybody's talking about, and rightly so, is that things are really booming at the moment. We've come out of lockdown for the most part, no matter where you go. There are a handful of restrictions regarding travel and whatnot that have yet to be eased, but things are really booming as we come out of this period. However, cast your eyes across to China, and this is where the authorities there have already responded to what they see as excessively strong growth. They've already responded by tightening credit conditions, and they've been doing so for several months now. And at some point, that's going to start to have an effect on that part of the world, and by extension, the rest of the world. Also, just this past week, we've seen a specific move by the Chinese authorities to try and put curbs on speculation in commodities, including the key industrial ones, such as iron ore and coal. And so that's yet another form of de facto tightening of credit conditions when you try to reduce speculative activity to the upside like that. And so these measures, I think, will begin to have an effect. And while, again, we still regard China as an emerging market, in some ways they are, in some ways they're not. But the fact is, they're large. And if you have credit conditions tightening materially in that large a part of the global economy, there will be knock-on effects. While I'm still looking for persistently high inflation over the next 1 to 2 years, I'm also looking for a deterioration in the growth inflation mix. That is, inflation may surprise to the upside in its persistence, but growth could simultaneously surprise to the downside once we get this boom, this post-lockdown boom behind us. And China is a warning sign in that regard.
That's interesting, John. I did see the stories about China clamping down on sort of the paper leverage when it came to coal specifically. I mean, is that not in a way similar to the argument we were making earlier when we were talking about Basel III and gold, where clamping down on the amount of leverage and speculation that you can get in that market is going to lead to just a base increase to some degree in those actual commodities?
Well, look, I mean, Basel III, the point of Basel III is not necessarily to limit speculation. The point of Basel III is to require banks to harmonize the way in which they calculate their risk capital
Oh yeah,
provision against whatever speculation they're doing. And that, by extension, would also be the case with the gold market. Again, the gold market is just a bit of an accident within Basel III, as it were, because of the conventions within the LBMA regarding unallocated versus allocated gold. However, other factors equal, as we discussed earlier, it could well be the case that banks do reduce their activities in the unallocated gold market if Basel III goes through without allowing that to be an exception. And other factors equal, if banks are going to reduce their unallocated short books, they're going to have to wind them down and or back them up somewhat more with actual physical inventory. Other factors equal, it's probably gold price positive, but the extent to which it's gold price positive is very, very unclear. And again, we don't even know if the LBMA will succeed in getting this exemption or not.
Yeah. It was just the comparison with the sort of the shrinking of a paper market, possibly leading to higher prices when it came to coal. Seemed like I mean, but broadly, if we're talking about a broader commodity bull market and higher inflation, it's funny how these dynamics when it comes to government intervention are somewhat parallel to some degree. We do have a few more questions here. There is a question regarding whether or not there'll be a recording of this. There shall be, so have no fear. And we will send a couple of links around to a few of our e-letters, later on. When it comes to layman's terms, will it affect gold miners? I believe this is in reference to our discussion when it came to inflation and leveraged companies, John. I would say that inflation in a levered gold company would be very positive for gold miners. If you're, as John was saying, if you get a decent margin mining gold and you lever up, you take on a lot of debt in order to really enhance that margin, inflation will do very, very well for those companies. When it comes to comparing its price to money supply, gold doesn't look overvalued at all. Our politicians are clear they aren't going to restrain spending, so more monetization surely has to be the clear XAU, the Aurum driver. Would you agree with that, John?
Yeah, I mean, you can look at gold ratios versus narrow or broad money supply. You can look at it vis-a-vis public debts. You can look at it vis-a-vis financial system leverage, and so on and so forth. There are many different ways in which to compare gold to monetary conditions. Gold does not look expensive on any of them at present. And indeed, even when gold briefly was pushing through 2,000 an ounce some months back, even then, gold still did not look expensive in a longer term historical comparison vis-a-vis all of those metrics.
Right. Got another question here when it comes to the dollar and the DXY, the dollar index. This, the key driver for the gold price at the moment looks like the USD. What is your view on the direction for the dollar going forward, and what has been driving its recent strengths? I mean, this is a big question, John. A lot of people see the dollar as the sort of the most important price in the world, as it were. What's your thoughts on the dollar as it stands today? Because it's been interesting watching the dollar index personally. We did see a lot of weakness in it after the big spike back in March last year, and that was that was very good for pretty much everything else in the world. A weaker dollar. But from where we are today, what are your thoughts on that?
Well, look, the dollar was in a downtrend for a while, and we're seeing some retracement now, which does not surprise me. The fact that the United States is going to be throwing yet more fiscal stimulus around, other factors equal, you would expect that at some point to be met with some tightening of monetary conditions as an offset. Uh, Other factors equal, history will tell you that could be somewhat dollar positive. However, the United States has this huge external imbalance with the rest of the world, which requires the United States to attract a substantial amount of foreign capital on a regular basis in order simply to prevent the dollar from falling. And I believe that amount rounds to roughly $2 billion of foreign capital a day is roughly what the US needs to cover that running so-called current account deficit with the rest of the world. And so it really does require the US to perform economically in a way that is seen as at least as good as, if not superior to, much of the rest of the world if they're going to be able to continue attracting that amount of capital. Now, I mean, obviously every country has its issues economically, right? The euro area clearly has issues. Half of it hasn't grown in a decade, right? And Japan, of course, has its demographic issues. But what differentiates both the euro area and Japan from the United States is that their external accounts are basically in balance. They don't need to attract foreign capital to prevent their currencies from depreciating the way in which the United States does, the way in which the United Kingdom does. In fact, if you look at the cumulative external debt position of the United Kingdom vis-a-vis the size of its economy overall, it's actually in an even less favorable situation and really is dependent on foreign capital just to keep sterling where it is, much less to allow sterling to appreciate. So longer term, in my opinion, as long as the US and UK remain relatively uncompetitive exporters to the rest of the world and continue to import the amounts they do, then I believe that both the dollar and sterling will trend weaker over time.
Right. We do have another question regarding gold. With how might Basel III affect gold ETFs? Which is a very interesting question. Correct me if I'm wrong, John. Basel III, when it comes to allocated and unallocated, gold ETFs don't use the unallocated gold. They use gold futures instead for their paper component. Am I correct in that claim?
It it depends on the ETF, and most of the big ETFs, having read their prospectuses, most of them have the flexibility to manage their short-term liquidity using forms of unallocated gold. That is,
Ah,
sort of intraday, if they want to deal in futures or deal in unallocated LBMA gold, they can do so. But the understanding is that they're always settling into physical at the earliest possible time, getting their hands on actual allocated bars. And I believe all the major ETFs publish their bar lists practically on a daily basis. So you know precisely what they're holding at any point in time in terms of actual physical allocated gold. So unless there's some form of fraud taking place, you can be confident, I would assume, that those bar lists are that the bars really exist and they really belong to the ETF. But keep in mind, perhaps on an intraday basis, there could be some unallocated gold in the mix. But is that really a major risk? Maybe in a major financial crisis, if they were facing withdrawals and they found they had some unallocated gold in the mix, that could be a problem. But that would be a very, very specific and unusual event.
right. On that note, with Basel III, though, the ETF providers themselves, will they be broadly affected by those Basel III
They'll
regulations?
they'll only be affected to the extent general market liquidity conditions are affected and dealing conditions are affected, as per our earlier discussion. That is, if for whatever reason multiple market makers decide they just don't want to be involved in the London gold market anymore, then other factors equal, the costs of dealing are likely to go up, and yes, ETFs have to pay to deal in gold. So it would, I guess, increase their transactions costs, and their fees perhaps would have to increase as a result.
Right. Though in some ways you could argue this is sort of a good thing for the gold ETFs in that if that were the case and unallocated gold was getting was harder to procure, well maybe the ETFs would be a little more reflective of owning physical gold because they'd be turning to physical gold somewhat earlier.
Well, keep in mind, I mean, they were created to allow investors access to physical gold. I mean,
Yeah.
that was the reason they were created in the first place, and the only reason why their prospectuses allow them to potentially dabble in unallocated forms of gold in the very, very short term is just liquidity management, right? Intraday liquidity management, without which it would be very difficult to provide liquidity. There's always a trade-off in a market. This is true of a fund or trust structure. It's true if you're a market maker. It's true if you're an investor of any kind. The fact is, there's always a trade-off between liquidity and cost. You want liquidity to be high and you want transactions costs to be low. But the fact is that market makers still need to make money,
Right.
and they need to cover their overhead. And their revenues are some combination of the bid-ask spread of the market and the volumes in that market. And they need to hit some minimum return on their market making activities, or they will withdraw. And that leaves fewer market makers who naturally will be able to perhaps potentially increase their margins as a result. This is the yin and yang of markets, right? So to say that ETFs will benefit from any of this, well, one would hope they wouldn't be hurt by it, but there could be some short-term disruption.
Oh well, I meant more for investors will benefit in gold ETFs in that they will be buying something that will have maybe more physical gold in it, or will be less risk of them owning any unallocated gold.
Again, I think the risk was low to begin with,
Yeah.
but to the extent that there was perhaps some residual unallocated risk, swirling around the ETF landscape, yes, this should reduce it.
Right. Well, there you have it, Peter. That is Basel III and gold ETFs. Now, John, it has been, I think it's been a very good pilot episode. We've explored quite a lot of themes here. Basel III is a it's almost nebulous topic. There are quite esoteric to some degree, but it is really very broad ranging. It's good to cover some of the interesting ways it will affect markets going forward. We have had a nice little chat on inflation as well. But we should wrap up around this time, I think. Thank you all for those who have tuned in. And indeed, thank you, John. In terms of sort of future episodes, it'll be great to cover more topics and more relevant themes as we go forward. But we'll hold it here. There will be there will be a recording of this made. You will be able to find it on our YouTube channel shortly. And we hope to do another one of these in the future. So it's now 10:54 on Wednesday. It's on Hump Day. And we shall be back in the future with episode 2. That's all for now. John, thank you so much for joining me.
Thank you, Boaz.